Welcome back to another MGI investing tutorial. This is Barrett, and today we're going to be taking a look at the Dow Jones Industrial Average. So here in front of you guys can see the /YM, which is just the mini Dow Jones Industrial Average future. I got a couple of lines graphed on it for you guys to look at. As most of you guys that have been following the market, you're aware that we've had some pretty significant pullbacks in the past couple of weeks. Actually, we had the high of 29,543. And as you guys can see now, just yesterday we actually hit 20,000, which is about a 30% loss from the high. We actually pulled back after Trump had some good news about how the government was going to come in and actually support this economy. And so a lot of shorts, I'm sure, were trying to counteract some of their long-term short calls and increase the market. The biggest point change in, I think, in the stock market history, yeah. So now we're actually sitting, it says 22,664, and I guess that's the mini Dow Jones, but I'm pretty sure that the Dow Jones is actually around 23,185. So it was a massive 2,000 point gain basically Friday, March 13th. And today we're basically going to be talking about some of the Dow Jones history, how that might be affecting the Dow Jones today, and how possibly we can be using this information, all the past closing numbers, to make the best prediction of how the stock market is going to react in something so volatile, something I've never seen before. And I think the only way to really understand that and what it's doing right now is to go back into the past and take a look at what it did then. Okay, guys, here we go. So we have the Dow Jones Industrial Average logarithmic scale. So as many of you guys are familiar with, the logarithmic scale is basically a 10 times on the y-axis. You guys can see it going up right here, 10, 100, 1,000, 10,000, 100,000. And we're sitting pretty about this, I don't know if the chart's been updated, but this is probably around the $27,000, $29,000 range, maybe at the high, and it hasn't accounted for us coming down. I'm not really sure, actually. It's not too specific on the dates. But it doesn't really matter. What matters is this is the Great Depression, the massive perspective that you now can see using the logarithmic scale is basically what these downs look like and what the ups have looked like, and how we basically have been 10 timesing every so often. I think that's the main takeaway from this chart right here. So as you guys can see, this is like the 1929 Great Depression market crash. We went from, I'm pretty sure this is about an 85% downside right here. And whatever amount of period this is, it looks about like a year, 2 years, 3 years. But basically the recovery period is tremendous compared to this downside. So the recovery was probably, 26 years, 30 years right here. And so that's one thing to take note, that massive change. It's always going to be different. So like the stock market, the bubble in 2008, you guys can see, it was about a 50% change in the stock market prices actually in that time, 50% drop, and it looks minuscule almost compared to this change in 1929. And it's basically this logarithmic scale just puts it into perspective for us. So right now we're looking at about a 30% downside of where we're at currently, which in perspective to the 50% or 85% leaves a lot more room for deviations from where we currently are. But we're going to get into some of the more of the technical analysis, fundamentals, and basically all points and sides going back from 1915, I believe, and just kind of looking at the data and how we can predict using those averages of what it might be doing in the future. Okay, here we go, guys. So this is basically just a bunch of data that I pulled from various dates, years, closing prices, just to kind of see and gauge what the market has looked like, the history. We have another logarithmic scale right here in front of you guys that I actually created myself, using a bunch of data that I pulled from about 1985 to 2020. So as you guys can see, we're in a very consistent uptrend. It's definitely been uptrending. It does look as though that we are on the bottom side of the uptrend since about 2010. After that crash or the bubble in 08, the recession. That is one thing to note though. Being underneath the curve is really important, because it shows that there is an upside to where we're actually at right now. Like, we're below the average since 1985. So this past 35 years, we're below the average of where we should be increasing if we were doing the 7.2 years at 2 times. So down here below, I have some more data that I've put together for you guys. So here we have the dates from 1915 all the way to in 2013. So these are all about 7.2 years apart, give or take. Some of them are a little bit off. It was just the easiest dates I could pull from closely around that 7.2 years. And basically, the rule of thumb is that every 7.2 years, the stock market, if it's going up 10% each year, it should be doubling or two times every 7.2 years. So over here to the right, you guys can see I have some numbers. This is basically, it should be two times if we're doing the 7.2 years. These dates are very close to being 7.2 years apart. And so these numbers should be two times multiplied by the previous 7.2 years. I have another indicator over here you guys can look at, the averages. If it's actually above or below that two times indicator, is just an easier way of looking at it, I think. So basically, if you have the squares, it's going to be below the two times average that it should be, or actually in this case, the 1.69. And if you have the circle, it's going to be above the average of these years from these past 100 years from 1915 to 2013. So actually, if you take the averages of all these, this is this point down here, the 1.69. So theoretically, the market should have multiplied by 2 every 7.2 years. In reality, they did not do that. They went 1.69 times every 7.2 years. But it's still a very good indicator. And now that we actually have this number of 1.69, we can use that to actually predict more in a more precise way of what actually could happen in the future. So currently, you guys can see right now, we're at about a 1.56 multiplier. If we ended right now for the 7.2 years at 23,185. Obviously, it could very well end at 23,185, but there's a lot of negatives or whatnot with the coronavirus and other things that could factor in to make this recession, bear market worse than what it is. And I kind of want to put it in perspective of what actually the numbers look like and what the future may hold, even with that recession happening. So guys, we're at 23,185 right now, which is about a 1.56 if we ended right now at the end of the year in November. But actually, what happens if we end at 15,000? So if we're still doing the 1.69 times every 7.2 years, in the next 7.2 years, if we end this year at around 15,000, in the next 7.2 years, we'll be looking at about 25.4. In the next 7.2 years after that, we're looking at about 43,000. And the next 7.2 years after that, we're looking at about 72,000. Now, worst case scenario, what happens if the stock market goes to 10,000? At that point, we're losing about 66% from our high. In the next 7.2 years, we're looking at about 16.9. The next 7.2 years, 28.6. And the next 7.2 years, 48.5. So to put this in perspective, in the next 30 years, the downside is very minimal to what we could be seeing potentially using that average 1.69. Even with the greatest downturn, which is the Great Depression right here, see these two negative years, we actually did not even stay the same. We're losing money, or these 14 years. It's just because that recovery period was so long. But even in the end, we have this average of 1.69. Holding it through this time period, you're going to see gains. Most people, though, they look at it as a very, so like a now situation. But I think one of the main things to look out for is that the market always recovers. It always is going up because businesses are always growing. They're always posting more revenue. They're always adding new features. They're always adding new things. And I think that's the biggest thing to like kind of wrap your head around. And you have to think, okay, what are these businesses worth and how much of the coronavirus fear is actually factored and baked into these prices? I personally think that we are going to see ourselves in a fade to rally type of market until the uncertainty surrounding the coronavirus is actually brought to fruition. But I do see upside from where we are now in the big picture or the longer term of things. So thanks guys for watching, and I hope to see you in the next video.